Hi there. A client has asked a really interesting set of questions, and I thought I'd have a go at doing a video on this. It's um, it's the fifth take I've done this morning. It's such a big set of questions, and they are critical questions to answer. So I can shortcut the whole thing and say I'm in. I want to invest in property, and I don't see any other investment vehicle being as good as this. Uh, but anyway, what I want to do is break all this down into chunks and then we can kind of work it out from there. Now, this is the question, and it's actually multifaceted. So, the first question is what about interest rates? Are they going to rise or fall? What do we think is going to happen? There's a recession coming, yes. There's a lack of buy to let products, especially for foreign nationals, yes. There's high energy costs, absolutely. And then we've got market turmoil because of the mini budget that just shocked the markets. And then the question is, what do you do over the next couple of years? And then another question is, well, what price point do you go for if you've got some cash? What's the safest, best long-term thing to do? And then is it better to just buy for cash and refinance later? And then finally, what about just getting out and putting money into bonds? So many questions, and they're all actually very good ones. And the person who's asking the questions knows a lot about money because he works in banking. So I'm glad he asked because they're the same questions I've got, which I haven't really vocalized, as it were. But I think for most of our clients, they are professionals, successful professionals on the whole, and they have to be to get the cash together to buy the assets and so on. And I think for most of our clients, they kind of understand the essentials like yield and condition, and then they go from there. And so generally, I just don't get into these big, quite cerebral topics, but I am going to give it a go today. All right, let's start with the very first question, the UK-US interest rate. Now, there is another variable to this which hasn't been talked about, and that is the Hong Kong dollar and the power or the strength of the dollar against the pound. So I want to deal with that very first. And if you were buying back in middle of last year, a year ago basically, you would have been at $10.51 to the pound, and now it's 8.66. So that's actually a 20% gain. 10 point, we said 10 point, I'll go there, 10.5. I'll just go 10.5. Right, so if you'd bought not at the peak strength, but just somewhere around here, maybe middle of last year or whatever, February, April, that kind of time, then your purchasing power has increased by around 20%. And if you were really on it and you jumped to it and bought at the very dip, then your purchasing power would be even greater. I think it's something around the 20% mark or even higher. So 22%. So the very first thing to remember is that you're in a very strong position, relatively speaking. What does this mean in practice? Well, let's just be conservative and say 15% discount. So you've got a house and it's £250,000 because that seems to be a price point a lot of people are interested in or were. And if I multiply that by 0.85, then that's £212,000. In your terms as a foreign investor, relatively speaking. So immediately you're in a really strong position because you got buying power and stuff is relatively cheaper for you simply because the dollar is very strong. Then, of course, there's a question, which is that dollar going to stay strong forever? Well, these things do work in cycles. As you can see here, and right now it's on a down cycle. Will it go further down? I don't know. Probably not. But then we don't know how the dollar is going to behave. But as we know, the Hong Kong dollar is anchored against the US dollar. So, in my view, if you look at just general historic cycles and so on, they go in cycles, and the dollar is unlikely to remain super strong for a very long time, because if it does, it's going to really damage the global economy, and that will force countries to try and find other currencies to work with that aren't killing them, as it were. So, in other words, if you think about global reserve currencies, you could say there's the euro, arguably the Chinese renminbi, but it's not a contender because I don't know why, but I know that economists say that it's so, and obviously the dollar. And so, anyway, if the US just keeps hiking interest rates and it starts squeezing the world will just start to find another way to hedge themselves against the US dollar. In other words, they'll use other currencies that as a means of exchange. So the odds are that the dollar won't remain super strong against the pound forever, and therefore your buying power will decrease. So that's one thing to think about. You've got a moment to grab. Then the next question is the one about inflation, because that £500,000, if you look at inflation rates historically, for example, where that money that I've talked about, let's just go and look at inflation. So how high? If we look at historic inflation, then we can see that in the 1940s, we have very similar issues to today, supply side inflation. And the reality back then was that there was so much government debt that the UK government couldn't afford to raise interest rates too much, otherwise it would increase its own debt burden too much. And we now see the price of gilts. So I'll get that tab open. And here I've got some charts from Trading Economics, and we can see various gilt prices. So this is cost of interest. And if I go, say, 10 years, you can see here, cost of government debt, very low. Cost of government debt, very high for a 10-year bond. In other words, it's a financial instrument which will mature in 10 years. And if the government has to bear this kind of interest rate, it's going to cost them a fortune, a huge amount of money to service this debt. And this is why the markets have all gone a bit crazy, because they're saying, well, the cost of debt is so high that if you do economic, if you try and stimulate the economy simply through paying for this via debt, then that's just a nonsensical approach to take from an economic point of view. And here we have the gilt price for 2-year and so on. So this is the price of money, basically, and the price of money to the government. And so if we go back into history, what we find in the 1940s is that they had to keep interest rates relatively low and allow inflation to run relatively hot. The red line is inflation, green is interest rates, because of the amount of government debt. And now we have, I think, government debt is somewhere around 100%. Let me get the thing out. And here's government debt to GDP going back 25 years. In fact, I'll just go back to max. All right, so it's hovering around 100%. Now, if we go back to history, around the 1940s, there was massive government debt all the way from World War I right up into the 70s. But the difference was, a lot of people reference the 70s and go, well, interest rates could go up to 15, 25%, whatever, or to 17, 18%. But the reality is that in the 70s, there was very little debt around. But in the 40s, there was a lot of debt. So interest rates remained fairly low back then. And today, we have quite a lot of government debt. Not as much as it was in the 40s, so historically it's not a ridiculous amount. But the reality is that if you're a sensible government, you're going to want interest rates to remain relatively low, so your cost of debt maintenance remains relatively low. Then you don't have to charge loads of money in taxation, which then balances the books and everything kind of carries on nicely. So then the question is, well, what about interest rates? Which way are they going to go? And in my view, I think you just have, again, look at history. History never repeats itself, but it certainly rhymes. And what I'm seeing is, yes, there might be 4.5% base interest rates, something like that, but it's unsustainable to raise interest rates too much, because it will just simply nuke the economy. And part of that is because of the financialization of house prices. So again, let's have a look at another chart. Here is house prices over the last 20 years. I'll go 25 years. In fact, I'll go max. And you can see here, really what we're interested in is 25-year chart, actually. So everything from 2008 onwards, and you can see that there was a decline. But remember, I've shown, I don't know if I'll just show you this. So average house prices declined in very different ways, or to very different degrees in different areas. Northwest decline was 15%. Average across the whole UK, more like 20-25%. However, if you've been sensible and you've bought in a place which has a solid enough economy, local economy like Manchester or Doncaster, Sheffield to some degree, whatever, then you're unlikely to see this kind of crash. But anyway, that's not really the point. The point is over-financialization of the housing market. When the market starts to get up to this kind of level, and it did after COVID, so you had January, February, March, I think it was March 2020, COVID hit, and there was a lot of money injected into the economy, which then ended up stimulating house prices. So the bottom line is that affordability is tanking. If we look at this chart, which shows mortgage affordability over time, we can see that in the last two property cycles, or peaks of the last two, the 87, 89 crash and the 2008 crash, affordability declined, and a larger segment of people's take-home pay was sucked up into mortgage payments. And now we see this happening again. So if COVID had never happened, we just would have had we would have had a steady rise in housing prices, and affordability would have declined because of the cost of property. And you can see here how things kind of arced out, but this is average national. It's very important to remember markets are very localized. So where I'm going with this is that interest rates, let me get the interest rate chart. Interest rates prior to 2008, as you see, were hovering around the 5%, and then obviously they just went to zero again. Now this is very, very similar to World War II, where you had higher interest rates in the 1930s, and trying to make it big for you so you can see it. Higher interest rates in the 30s, and then as the government tried to prop up the economy, they dropped interest rates, and because of the high government debt, the faltering economy for a long period of time, there was nothing they could do except keep interest rates low. It was only in the 50s that things kind of recovered. Now, I think we're in this period in the 40s where there was massive supply side inflation. They had to raise interest rates a little bit, but my prediction is that interest rates will come back down again as demand destruction takes hold. Assuming, as demand destruction takes hold. Because the nasty thing about today just like after the Second World War, is that things you need cost more money and you can't avoid paying for them, like energy. And that drives the interest, the cost of wages, and so on. So, okay, going back to the question, which is, what do I think about interest rates? Well, that's what I think. I think they will go up a bit more, maybe, probably. And I think the US will will just squeeze and squeeze until something breaks. Then they'll pull back. And, but I think at the moment we have raised interest rates so we have base interest rates, and then we have the premium on top of that, which is what banks are charging extra to cover risk. And the thing about banks are that, and I don't really understand this world at all well, but broadly, as I understand it, banks buy money from a market, and then they resell money and they take a margin. And the margin reflects the amount of risk involved in lending that money out. So if they're lending money out on credit cards, for example, it's very high risk versus a mortgage, very low risk. And thus the cost of the interest rate varies significantly. So what I think is going to play out is, yes, I think we'll see some more interest rate rises, but and I think that will subdue the housing market. But I think what people will do is they will downshift a little bit. They'll go, right, I need to move for whatever reason I need to move. And then they'll go to, what they'll then do is they'll just go, okay, well, I'll buy something cheaper that's affordable, but fulfills my requirement of I need to move here for whatever reason, for work or schools or whatever it is. So I think that's what's probably going to happen. There's so much depth in the market that, for example, in the summer, typical thing, 15 viewings, 6 offers for a nice property in decent order. These days, I'm seeing same property, 15 viewings, 2 offers or 3 offers. But those people who are able to offer have a lot of equity, and therefore they're going in at lower loan to value, which means that the property is affordable because they have cash. And that's what keeps things moving along. So then we're into another topic, which is inflation. So if you're sitting on a pile of cash, okay, so to conclude on the question about interest rates, in my view, and in the view of a lot of people who actually know what they're doing, my thing is houses, and I'm good at condition assessment and all that kind of stuff. But overall, if the government decides to go hardcore on interest rates, then they I'm just looking for, if the government goes hard on interest rates, then they're going to nuke the housing market. And if they do that, well, worst case scenario within reason would be 2008, where the banks just literally went into seizure and they just didn't offer finance anywhere. But that was because there was a lack of discipline in lending, and people who were not creditworthy were getting financed, and that then led to the demise of Royal Bank of Scotland, I think it was, and there was another bank as well, which name escapes me. But anyway, the point being that the market went into seizure, and we had in the northwest a 15-16% decline in property prices. This time around, I don't see anything similar to what had happened in the 70s, because it's a different economic environment, and the Conservatives are in government, and they really, really, really care about voters who own homes, because they are the ones that tend to vote Conservative. And if they destroy house prices, then they destroy that feel good that people have who vote Conservative, and therefore it really damages the Conservatives' chances of getting elected again. So destroying the housing market is bad for voting or bad for getting re-elected, and it's bad for the economy in general because it erodes people's wealth, makes them less creditworthy, therefore they can't get finance, and the whole thing just ends up in a kind of negative cycle. So the way out of that problem is to make sure the housing market doesn't collapse, but simply goes sideways. And so after the last crash, you had a period of 4 or 5 years where everything just went sideways and affordability returned because inflation, cumulative inflation, might have been 10, 15%, but it meant that house prices after a 5-year period after the crash were 15% cheaper, relatively speaking, relative to wages than they were before at the beginning of the bottom of the market. So anyway, I suspect that's what's going to happen this time around. Prices will kind of carry on going sideways for a while, and inflation will take hold. And during this flatline period, you'll have rising wages due to inflation, house prices stay level, and what that then means is that house prices gradually become more affordable, which is what happened after the crash. You had a period of low affordability, there was a crash, affordability returned, those who could actually get finance were in a better position, and then inflation did its thing over a long period of time, and property just gradually became more and more affordable, relatively speaking. And we see this all the way through to late 1990s, early 20s, 2020. So inflation chugging away, property prices creeping up, but inflation higher than interest rates, and therefore property became relatively more affordable. Now, if it all turns on its head and property becomes terrifyingly unaffordable, like it did in 1990, because of the massive spike in interest rates back then, and if we look at the historic chart, we'll see, where are we? 1990, here we go, here, the green line, then that will just nuke the property market. And no one wants a return of repossessions and just the chaos that ensued after that. So that's the likely outcome, I think, on interest rates and house prices. I just think everything will creep along and go sideways. Interest rates might increase a little bit, but not substantially. So that's the answer to that. But then the next question is, what about inflation? And what about, I'm sitting on a pile of cash, what do I do? Do I wait for prices to drop, or do I get in now? And I've done a video talking about this, and I was with Sarah on this video, and I built a spreadsheet covering this whole topic where I modeled the thing out. And broadly, what I think will happen based on my modeling is that if you can get finance and the rate of interest is lower than inflation, and assuming rents go up in line with inflation, because rents are essentially a day-to-day cost, a bit like paying your electricity bill and so on, then over time, your debt gets much smaller relative to your income. And that's a good thing. So broadly, if you're in debt and you've got high inflation, that's and it's a fixed rate debt, that's good. So that whole model was perfect prior to this madness that just happened with the mini budget. And then the whole market just went a bit bonkers. And as we see, when I duplicate and I go to government or go to money, and here we are here, markets, government bond 10-year, then market interest rates went up crazy, and the price of money increased. So there is a metric, the LIBOR rate. This is the interbank rate, and this is the rate at which money is borrowed between banks, and you can see it gradually creeping up in line with interest rate increases. But then we had the shock, and there was a spike, and now it's sort of settled down at this. And I suppose it'll plateau out. Who knows? And then what I expect will happen is that bank interest rates will drop a little bit. And then we've got the big question, will actual interest rates increase? I don't know. That's a question. We'll find out. My guess is that if the interbank rate continues at a slightly elevated level, then the Bank of England may hold off on interest rate rises for the base rate. I don't know. But anyway, it's a very big topic. The main point I'm making is that, yes, I expect interest rates to go up, the cost of borrowing to go up, but you've got to offset that or weigh that up against inflation. So let's have a look at inflation. Okay, here's inflation. And if we see inflation's gone crazy, but it's, let me get another chart. Here I've got the interbank rate, but actually I'm going to get the bank lending rate because I think that is more indicative really of how people are feeling and how things are moving for the average consumer. As you see here, for a long time, inflation was kind of oscillating around the interest rates. Sometimes it's a bit lower, higher, whatever. But we still have a gap between inflation and bank rates. So here, for example, it was the opposite, going back to the 2000s and what have you. So therefore, if you think about it, if you have a loan of £100,000 and you're paying 6% interest, that's £6,000 a year in interest, and inflation was say around 1.5%, then in aggregate you're down because you subtract the rate of inflation against the interest rate, and therefore each year you're paying 5%. It costs you 5% as compared to inflation. But in this case, it's the other way around. And it's been oscillating the other back and forth over the last 10 years. But in this case, we're still in this position where inflation is higher than the rate of interest. And I draw your attention once again back to the past. And that's exactly what happened in the 40s. So what I think will probably happen because of cost of government debt and financialization of real estate, I suspect that interest rates will remain below the rate of inflation. And therefore, if you think about it like this, your income, i.e. your rent income as a buy-to-let landlord, or if you're an owner-occupier, your actual income will rise in line with inflation typically. And your interest costs are lower than inflation. So in aggregate, you make money. So let's say we just spread it out over a 5-year period, and we say that the total, let's say it's 5%, just for round numbers. 5 years, 5%, £100,000, that's £25,000 in debt, roughly speaking. And let's say inflation averages at, for example, 6% or 8%. Let's call it 8%. So 5/8 of 40 plus a compounding effect. I'll just call it 40. So that means that the value of your money has eroded, the value of your debt has eroded by 40%. The cost of maintaining that debt is 25%. Therefore, if you break it apart, you're actually up 15% in real terms, in real wealth, simply because you had borrowed money for that duration. And prior to the blip that we had, if you had got a 5-year fixed, as I'd been imploring many of my friends and various clients and just people, then you would be in a great position. Thankfully, I got a 5-year fix before all this madness kicked off, and I'm now up 7% each year. If I break apart the rate of inflation and the cost of interest, there's a 7% gap, which is great. So my debt is being eroded in real terms by 7% each year for the next 5 years. And as I say, I expect interest rates will settle down again because of the cost of government debt. So the only time interest rates start to creep up again, arguably, is when the economy actually recovers. And for something as traumatic as Brexit, and again, looking at history, it takes 10 years, at least a decade at least, or more, for economies to reinvent themselves and pick up from where they left off, or from whence they left off last when it was good. So I absolutely think it'll be 2030 or more by the time everything is kind of settled down and the economy is starting to pick up. And thus you've got higher interest rates simply because there's more productivity, there's more wealth, and the economy has to sort of remain under some control. Okay, so that is that narrative. And what am I going to do in respect to this? Well, if I had to buy something right now, I'd either buy it for cash because there are so many vulnerable buyers. Okay, let's just talk about that for a minute. Based on what I'm seeing day to day, because I talk to agents all the time and I'm watching what goes on in the market, what's happening is lots of deals are coming back to market because mortgage offers have collapsed. And in my view, there's a window of opportunity, probably a month or two before things kind of resettle. So we've got two things going on. Foreign national investors are out of the game unless they've got a pre-existing mortgage offer until the banks come back. Now, apparently Gatehouse will be back in a few weeks' time, and they'll probably have a relatively higher interest rate, obviously. And then it's a question of doing the numbers then. But broadly, if interest rates are lower than inflation or expected inflation, you win. And so for me, I'm waiting for a tranche of money to come through, and then if this madness continues, what I will do is look for really good properties with no compromises that I know will be great assets forever, and I would go and buy those for cash and then refinance later. And the reason for that is really simple, actually. If we go back to the charts, what happens is people lose their minds, and they once shocked, twice shy. And so what happens is you get this kind of zeitgeist where people are afraid and demand is low and the market kind of stabilizes. And what I absolutely expect to happen is that there will be a prolonged period where the market will just flatline and you'll be able to get great deals. But the catch is, and I know this from experience, dealing with investors, they're part of the herd as well. And they go, well, surely there's something wrong with it or whatever. And this is where understanding a good property and how to assess deals is really important, because then you can look at it objectively and go, well, actually, there's nothing wrong with it. It's just that people are afraid. Why are they afraid? There's no good reason other than it's the herd, i.e. the herd of people just being afraid. So what I think is going on right now is that we're starting to get a bit of that fear. But it's tempered by massive depth of demand. So there are relatively few buyers, but you only need one strong buyer or two really to compete for a property, and then the prices creep up again. So I suspect prices are going to stabilize, and what I think will happen is that a lot of properties that are coming back to market will have vendors that are terrified, that really have to sell, and there will be value to have, but you're not gonna nick it. In other words, so I've got a client who is threatening to pull out of a deal. and they want a 5 or 8% discount because they believe the market's crashing. I just don't agree with them on so many levels, apart from the fact that you don't break a deal at the last minute. That is terrible behavior, and it's just a quick way of causing trouble. But that aside, the point is that I really don't see the market crashing because there is so much depth of demand. What I do see is certain places getting really hurt. So London and Southeast, where there's so much debt, that any increase in interest rates is incredibly damaging. But most people have got their interest rates fixed and they're insulated from this situation. But over time, if high interest rates persist, then obviously you're going to have more and more trouble. But what it does mean is that anyone buying a property now, suddenly that property is 3 times more expensive to own than it was 2 years ago. So in terms of cash outflow. So therefore, the top end of the market, the very top end of the market is insulated because those people just buy for cash. But it's the mid-market, the 1 million to 600,000 or 400,000, that area that's being demolished in London. But in Manchester and places like that, a decent property is £200,000, 250, and at that level, there's a lot of equity in the market. And I know this because I talk to the agents, and we have conversations about these things. And it's very different to 2008. There is much more equity. So people are simply going down a level. They're just buying the next level down because they have to, because they got to move for schools or work or whatever the reason they got to move, they do that. But instead of trading up, they just go sideways or down. And for clients, what they're doing is they're just going down a level, down a category to the cheaper properties with the higher yields. So in other words, when 5.2 to 5.4 gross rentable yield would do, they're going to 6.6% and 6.5. But there is a delusion that you can get a really great property cheap. No, that's not the case. What you can do is get more of a chance of getting a nice property at a sensible price, which is a very different story. So for that client who thinks, well, the market's going to crash, they're wrong, in my opinion, and in the opinion of loads of other property professionals I talk to all the time. So don't bank on that. All right, so if we just go back a few steps and we look at interest rates. I think interest rates are likely to rise somewhat, but I think we are in a madness blip which will settle down. And I think if it was me as a foreign national buyer, I would just lower the loan to value. As long as interest rates are lower than the rate of inflation, I'm winning. And also it gives me more leverage, therefore I can buy more property with my money. So previously, clients were buying at 80% loan to value, which I think is far too high in these circumstances. I think 65% is probably about right, where you can be cash flow positive, you can buy an asset that's really solid and is a hedge against inflation. So the other question is, well, what if I don't invest in property? What if I invest in gilts or interest rate things? Well, fine. But the catch is that your rate of interest from those investments will be lower than the rate of inflation. So you're going backwards. Now, arguably, you could say property does that too. But there's one critical difference. As an investor, what you're predominantly interested in, or should be for now, is cash flow. Because it's very likely the property market will just go sideways. Now, when the market creeps up, then it's a different story. You can gear up and you can refinance and buy more property and expand your portfolio during those times of the market rising. But that's done for now, I think. And therefore, it's just cash flow, and cash flow will increase over time because rents increase over time in relation to inflation. Therefore, and also I think for a lot of investors, it's just what do you know and understand? And I understand property, and that's why I like it, and that's why I want to stay with it. I have a friend who had £1 million to invest, and she's a property person, or was. She put it into a fund management company 2 years ago, I think it was now, 3 years ago. And she was in loss for a year and a half, 2 years. And she told me the other day she was really happy. She was cash flow neutral. In other words, she was neutral on her fund or on her investment. I hated to tell her that inflation has eaten 15% of the value of that, or even 20% over the last 2-3 years. So in reality, she's down £150,000 minimum. But if she'd bought property, she would have been up 20% on inflation if she'd bought well, i.e. good property in Manchester, places like that. So I think there's a lot to be said for just sticking with what you know, and therefore you can outcompete others who don't understand your topic as well as you can. So if you're a money person, you understand that world and you can get 8-10% a year, great. Without the hassle, great. But there's a high risk with that. And I think property is still relatively low risk and relatively good return. Then we're into a couple of other questions, which is, what about all of the cost of living crisis? Well, the government has backed the country into a bit of a corner because they have triggered a rental availability crisis because of Section 23, I think it is, the tax changes, where they made it really, really expensive for higher income people to own buy-to-let property. In other words, you're not able to offset the cost of interest against personal taxation, and that's what triggered this huge sell-off with investors and a huge buy-up with limited company investors. But what's actually happened in reality is that if you take 2017 versus now, the proportion of the percentage of property available in the market is halved, apparently. Now, I've never seen the data, but I've seen Rightmove talk about it, I think, and a few other sources. So I believe it to be true. And it kind of makes sense to me. So you've got less properties around, huge rental demand, and I see this from my data, my day-to-day data that I use for property selection. There's just huge demand everywhere, except for the most deprived of areas like Tyneside, Hull, places in Wales and so on. London, central London, still fairly weak and such. But overall, there's rent demand. So what then happens is that people with more income make more compromises, and then they just pay more to live in your property, because that's the market. They have to rent. They can't buy because it's prohibitively expensive to buy, and they just kind of give up and they go, well, it's easier to rent. So that's what they do. And therefore, I'm relatively confident that certainly in certain places like Greater Manchester, Doncaster, these kind of decent local economy towns, rent will keep in line with inflation. Thus, it will go up. So people will get poorer, but what they'll do is they'll compromise, they'll downshift. And so instead of going for a nice 3-bedroom house, they'll go for a less nice 3-bedroom house that's in a cost bracket that's a bit lower, that they can comfortably afford. So I'm confident about rents going up, or at least staying in line with inflation. And that's that. So then we're into, what would I do for the next year and couple of years? Well, if I had a big tranche of money right now, I'd buy in cash. So I'd just start looking for properties that are really, really, really nice, that have no compromises, that I know will always be popular and will always sell well and will always rent well. And I see lots of these around. And what I'm seeing generally is that we have more of a shout on better properties these days. In other words, my clients are getting more competitive, which is super. So it's not a case of get a cheaper property. It's a case of get a better quality property for the right kind of money. That's where I'm at. And so for me, what I would do is, as I say, keep looking, buy for cash, refinance later when everything just settles down a little bit. And I wouldn't refinance at 80%, I would refinance at 65%, something like that. And with that extra cash, I can buy another property and just increase the size of my portfolio, but keep the gearing a bit lower so that I have cash flow and I can take an interest rate shock if it comes along. So that's what I personally will do. For clients, I'm saying the same thing. If you've got an outstanding mortgage offer, fine, buy with mortgage, but just generally buy with cash if you can for now, and then let's just see what happens in a couple of months and just go for quality. So quality with a high yield. So I would go for 6%. If you're a kind of person who wants more quality, go for 5.7%. The weird thing about yields is that they are really, really correlated with demographics and quality of the house and so on. But there is a sweet spot where you can get high yields, you can get nice tenants, and it's very rare to get high yield, nice. For example, Droylsden, £250,000 property, yield is 5.6%, something like that. That's gross rentable yield. In other words, it's in rentable condition. So you buy the property, you fix it up, rent it out. The cost of the renovations plus the property equals gross rentable yield. And what we're seeing now are just more and more of these nice little terraced houses that are in decent condition that could get to EPCC if necessary, and they're getting 6% yield all day long. So just lower loan to value if you can. The only issue is that there's a minimum loan size, but there are banks who will, like Hampshire Trust Bank, who will wrap up groups of properties together. So yeah, that's what I would be inclined to do. And as I say, if you're in cash, you're in a very strong position, but you're not going to get it dirt cheap. The only time you get a property dirt cheap is if you have a motivated seller and a compromised property. But right now, what you have is you have motivated sellers, but the property isn't compromised. Therefore, what's happening is that people are making the offers that makes the property saleable at a reasonable expected price. In other words, it's holding. The prices are holding, and that's why. So the next question would be what price range? So just going back to that, I'd stay below the 250 mark because stamp duty increases obviously above that rate, and also yields drop. So it's not so much about the price, it's the yield. What is a sensible yield which is low risk? That's really the big question. And I feel that £220,000. So for the client who asked this question, for him I say 200, 220, decent modernish house built in the 1960s or sooner, or if older, thoroughly renovated, and in a decent demographic with good location, etc. All of that basic stuff, and achieving a yield of 5.6 to 5.8%, something in that order. For other clients, I think they are typically looking at 6% yield. And yeah, that all kind of works. So again, just lower loan to value. I'd go in at 70%. At 6%, but you've got this issue where you've got minimum mortgage sizes. So minimum mortgage size for Gatehouse is 75%, but I don't know if they're going to continue that low mortgage size when they come back to the market. Typically historically it was £100,000 minimum mortgage, and that's a question. So one thing I would want to do is get a call with David Eva, do a video all about this stuff. We talk about different mortgages and minimum and just what's going on. So that's something I'll chase him on. So we get that done. Okay. So that's the target thing. And would I buy cash? Yes, I probably would, considering, but I'd go for fast turnaround. And this is critical. So the problem with holding cash is inflation. So if you sit in it for a year, you've lost £10,000. If it's if you sit in £100,000, you've lost £10,000. Imagine how much work it takes to earn £10,000. So inflation is cancerous. It's horrible. And therefore, it's really, really critical you get out of cash quickly and into something that produces income. So my view, as I say, I would, until the mortgage market settles down a little bit, I would just buy with cash. But I would go for vacant possession, and I would go for properties where I've got motivated sellers, and therefore I can get a rapid turnaround on conveyancing, because as soon as the conveyancing is done, then I can refinance. Or during the conveyancing process, if the market settles down, great, I do a mortgage application and then I draw down the money upon completion or whatever. There are various ways you can do it, but that would be my game, I think, to go for real quality properties, and buy with cash. Then and multiple mortgage buy. Yes, but the issue is cost of interest. It's too high. So if we had this conversation 2 months ago, I would say get on and buy right now. Interest rates are reasonable, and you can get a fix for a while. Just buy. But it's a different system now. It's an ecosystem now. It'll come back most probably, because history tells us it probably will, and therefore I would be inclined to just wait and buy with cash when the right property comes up, be quite picky about it, and then refinance when things stabilize. Or the final question is, what about just put money into a gilt or something? Well, yeah, you could get your 4.5%, but it's below the rate of inflation. It's passive, so that's fine. But as I say, when you factor in all the other variables, I'll share my screen again. Let's find that video. When you factor in all the other variables, as I have done with this, assuming you can get a decent fixed rate interest deal, and assuming rents go up in line with inflation, and assuming you're going to hang on to the property for 15 years, in other words, you hang on to it till the next peak in the next cycle, and we know that cycles exist because they have for 170 years, then yeah, we know that they exist, and therefore it's going to happen again. So I'm just I think, let's go back to the question again. In my view, I get myself out of the way. Yeah, I just think that it's, as I say, with the story with my friend who invested about £1 million in property, she's down in real terms, or not in property, in just financial assets in the market and so on. She's down in real terms 15%. It's a lot of money to lose, and actually she could have played a different game. So I think with property, the long-term story is it's all about the cash flow right now. And it's about buying really good properties that don't have compromises, and letting them cook for a long time. And as time passes, the value of your debt that you take on board, assuming you can get a decent fixed rate and so on, the value of that debt will erode due to inflation, basically. And inflation is probably a long-term systemic thing we all have to live with. And so you make money through erosion of debt. You make money through the increased rents you get relative to your mortgage repayments, and that overall gives you a good ROI. So what would the ROI be? Well, the net cash ROI that I keep seeing around the place is like 2%, which is not great, is it? But previously, if you had invested 2 years ago, your ROI would have been somewhere around 15 to 20% a year because of the increased value. You would have geared up, you would have had a fixed interest deal, your interest rates would have been 2%, 3%, something like that. Thus your return on investment relative to your capital gain would have been huge, 15 to 20% a year, something like that. Now I think you're looking more like 10% a year, and that's the combination of house prices kind of going sideways, the cost of debt going down relative to rental income going up, and then in the long term another rise in property prices as we get to the end of the next cycle. So wherever that thing is, there we go. Another rise in property prices as we get to the end of the next cycle. And once you get into the recovery phase, which is probably 8 to 10 years time, and remember that's likely to coincide with the recovery in the general economy as the economy kind of remolds and reorganizes itself post Brexit. So then your ROI starts to really creep up, and you go from 10% or thereabouts to something much higher. So if I look at this one here, I've got the numbers which I pulled together, but the ROI, here we go, here, capital gain ROI. So it'll fluctuate over time, but for me, the real ROI number, if I can find it here, is the ROI, the return on investment relative to purchasing power. So it's likely to be, this is it here, and basically it's the return on investment when you reinvest. So there's a lot of moving parts to this spreadsheet, but the main point is it's somewhere around the 8 to 10% per year if you factor in eroding cost of debt relative to inflation, relative to increased rents. So in this video, I explain the whole thing in detail, and I'll drop a link in the description so you can watch that if that's any help. But it's a big, complex topic. So there it is. I think that's more or less it. It's for anyone who's still watching. Cheers. It helps me at least to unpack this. And in summary, final summary, what I would say is go for quality, go for higher yield, 6%, somewhere around there. Go buy with cash if you have the cash. Plan to refinance when the lending markets stabilize, and assume that the big payday will come 10 years from now, 15 years from now. But in the meantime, just get net cash income from this asset that you've got, and then you should be good. And I think it's a hell of a lot smarter to go down this road long term than it is just to sit with a financial instrument that's passive. Because, as I said, because of the way property cycles work, the gains are huge down the road. So that's that. That's what I plan on doing. What you want to do, don't know. You'll tell me through your actions, no doubt. All right. Anyway, thank you very much.